What's going on, guys? Welcome to Stock Talk with Nico Kritikos. Today, we're going to do some stock analysis for Moody's Corporation, ticker MCO. So, in the last year, the stock is up 22%. We're looking at a market cap of $62 billion, and Moody's engages in the provision of credit ratings, research, tools, and analysis to the global capital markets. So, the first thing we're going to look at here is revenue. The revenue for this company is fairly strong. In the last 10 years, they've averaged 7% growth. So not high growth by any means, but still consistent growth, and 5 to 7% is healthy. And the next 2 years, it looks like they are predicted to do 9 to 10% revenue growth. So it's actually expected to nearly double, which is a good sign. The net income for this company was 1.3. So the revenue for this company last year was 5.4 billion. The net income for this company last year was 1.3 billion, and they're averaging about 7% growth a year for their net income. So pretty similar to revenue. Now, there was a pretty big drop off from 2021 to 2022, but overall, I would say it's a somewhat consistent trend of them increasing their net income. Then we go to the price to earnings ratio, and I'm going to give this a no because right now it's actually trading at 34 times this year's earnings, expected earnings. And as you can see here, it's normally in the 20 to 30 range. So I really wouldn't call this a healthy valuation. From 2010 to about 2016, it was really in this range of 10 to 20. And then after that, it's been in this range from 20 to all the way up to 45. Well, at least this says it's 45, but really it's more like 34 times forward earnings. So this chart is for trailing earnings. But either way, it's more expensive than it normally is right now. That's something to keep in mind. If it came down to like 30 times, that might be an okay place to buy it and to buy into it. But when it's 35 or 40 times, that seems very rich. Are they innovative? I guess you could say they're innovative. I put yes because it looks like they are keeping up with a lot of different technologies like artificial intelligence and machine learning. So that's a good sign. It looks like they're using these technologies to do risk analysis and all that stuff. So I will give that a check. Strong market share. Yes, this company is famous for having nearly 40% market share, along with the two big players are Moody's and S&P Global. So and the good thing is like the government uses these agencies to measure how much risk certain things are. So that's another moat that a company like this has, and it's something that makes them stand out. Return on invested capital, 15%. That's good. That's strong. However, it's weak compared to what they do historically, because if you look back in the day, they were doing as high as 41%. Well, actually, no. Yeah. If you go back even more, I think they were doing over 41%. But in the last 5 years, it's normally about 23%, but for some reason it was only 15. 15 is not bad though, so that's okay. Is the equity growing? Yes. The only thing I don't like about this is that, so the equity is growing. It's gone from 800 million 4 years ago to now over 3 billion. So that's really good. But the assets are, majority of them are in intangibles and goodwill, over 8 billion. So that's more than half of their assets are in goodwill and intangibles. I don't really like that. The equity is not over 15%, especially accounting for when you take out goodwill. The share count is decreasing about 1% per year, which is good. And then the assets are definitely not 2x liabilities. Profit margins of about 25%, which is strong. And previously, it was the year before it was as high as 35%. So everything looks good there. Cash receivables is about 4 billion, which is more than double their net income normally. So that's good. Healthy dividend, yes, it's consistent. They consistently grow it, and the payout ratio is only 38%. So that's what I like to see. The company is over 100 years old, and the free cash flow is, again, somewhat fairly consistent and strong. This is adjusted for stock-based compensation, so it should look a little bit better, but it looks like they're growing it at an average of about 3% per year. So nothing. There definitely are some points when it dips off and it drops a little bit, but over the last 10 to 20 years, there's definitely a upward trend. So that's good. So I'm somewhat interested in buying this stock, only if, I mean, I was kind of expecting more, I guess, from this company. Number one, the valuation is too high right now. I would not buy this valuation. If the stock dropped like 30%, maybe then it'd be interesting. But right now it's not. But as for the business, so there's a couple other things. So if you look at, I looked through their investor presentation, and you just get a better idea of what they do and all this different stuff, which is kind of too complicated for me to understand everything, but it helps get a better idea of what they do and what they deal with. So I would say I wish I wish there wasn't so much in goodwill on the balance sheet, and I wish their return on invested capital was a little bit stronger. I was actually expecting more than 15%. So I don't know why those numbers are dropping off as far as ROI and profit margins go. That's the only thing. Other than that, I mean, I'm sure this is not a bad investment, just because, I mean, first of all, you can't expect high revenue growth. Or I mean, 10% revenue growth is actually that's a big improvement from where they've been at in the past. So I don't know. This isn't a high growth company, which I'm okay with that. But at the same time, it should not be trading at this high of a valuation. And I don't know. I feel like if you buy the stock, I'm sure it won't do bad. But I don't know. It's not super attractive at the moment. So that is my analysis for Moodys Corporation. I will see you guys in the next video.